Good afternoon and welcome to our first Lunch and Learn webinar series from the Fredericton Chamber of Commerce. And our topic today is personal and corporate taxation, which is brought to you by our sponsor, the University of Fredericton. My name is Krista Ross. I'm the CEO of the Fredericton Chamber, and we're really glad that you joined us today. Our presenter today is Jill Stairs. Jill is a CPA, CGA, and a partner with EPR Day Kelly & Associates here in Fredericton. She works with a diverse group of clients providing business advisory, assurance, and tax services for individuals, not-for-profits, municipalities, and small businesses across a wide range of industries. So I'm going to pass the mic over to Jill to begin today's webinar.
Thanks, Krista. Hi, my name's Jill, and I'll be guiding you through the presentation today. I'm a chartered professional accountant in public practice in Fredericton. I've got a background in IT, energy, and consulting before I moved into public practice, and I understand that navigating through the Canadian taxation system can be overwhelming to some. I'll try to make this presentation as informative as I can, knowing that I have a broad audience listening. So sometimes there may be topics that I'm presenting that will be simplified to some people, and to others, such as new Canadians, the subject matter may be quite complex. I look forward to questions at the end of the presentation, and I'll do my best to answer what I can in the time that we have. If there are things that you would like to specifically address later, my contact information will be on the last slide, and I'll be happy to set up a time to meet with you to discuss your personal or corporate needs. I have to add a disclaimer here that all the information in this presentation is current at the time of the presentation. Both the provincial and federal governments will be tabling new budgets in the near future, which could change the tax rates, deductions, credits, and incentive programs that I will be discussing. So let's get started, shall we? The presentation has been loosely split into two categories, individual and corporate taxation. One of the most common questions accountants get asked is, what kind of business should I have? When I start a business, should I be self-employed or should I incorporate? These are great questions, and the answers really do depend on the individuals and the businesses involved. As a self-employed business person, whether you operate as a sole proprietor or in a partnership, your business income is reported on your T1 individual tax return, while a corporation files its own tax return called a T2 corporate tax return. Both of these have to be filed annually. A general rule of thumb when you're starting a business is to ask yourself what you're going to do with the money that the business earns. If you need to use all of the profits of your business generates in the year to pay your personal expenses, there really is no tax advantage to incorporating a company, as the taxes that you pay will be roughly equal in the long run. The Canada Revenue Agency is getting much better at ensuring taxpayers end up paying roughly the same amount. This is called integration, and it's a subject for another presentation. Now, if you think that the majority of the profits you earn will be able to stay in the company to fund future endeavors, to build equity, etc., then there probably is a tax advantage and you would have a good case for incorporating your business. I would recommend having a good conversation with a professional in order to get all the information you can specific to your own situation in order to make that decision. I often will advise my clients to start the business as a sole proprietor and then incorporate later as the business grows and your income needs change. Individuals need to report on their tax return all the income that they earn throughout the year, and this is usually roughly divided up into several categories. Employment income usually comes summarized at the end of the year in the form of a T4 or T4A from your employer or the organization you provide services to. These slips can also come from volunteer services, such as a firefighter's stipend. Business income is just that, income generated from business activities. Property income is considered passive income. It's generated from investments in capital property, such as stocks, bonds, GICs, mutual funds, rental properties, etc. Other income is just that. It's usually support payments, educational payments, workers' compensation, employment insurance, that kind of thing. And then there's capital gains. The capital gains categorization was created in the tax system to promote investments by giving the investor a potentially higher yield on investment, and capital gains are subject to preferential tax treatment. Employment income is salaries, wages, commissions, gratuities, bonuses, director's fees, etc. Taxable benefits that are also included usually on your T4 slip are automobile benefits, stock options, relocation payments, interest-free and low-interest loans from your employer, any personal or living expenses that are paid by your employer that you need to take into income. There are several deductions from employment income that you can put on your tax return. Contributions to registered retirement plans, whether it's a RPP, which is a pension plan, or a registered retirement savings plan, professional memberships and union dues. If required by your employer, they need to fill out a signed, it's called a T2202 or 2200, which is basically permission to deduct other expenses, travel expenses directly related to your employment, cost of supplies consumed directly related to employment, expenses incurred by salespeople, interest and capital cost allowance on motor vehicles. There are two different options for expenses incurred by commissioned salespeople. You can deduct various expenses up to but not exceeding the amount of your commission income, or you can follow a general rule applicable to any employee, and it's not subject to the commission income limit. To see which is more advantageous to your specific situation, you should talk to your accountant. Employers are also required to withhold taxes on all employment income, including taxable benefits at the source. Business income. In common law, a business is defined as anything that occupies an individual's time, attention, and labor for the purpose of making a profit. In the Income Tax Act, a business is defined as including a professional, calling, trade, manufacture, or any undertaking of any kind whatever, and an adventure or concern in the nature of trade, but does not include an office or employment. This is not an exhaustive definition. There are many cases where you can argue that your income is in fact a business. There's a list in front of you of common business deductions. This is not an exhaustive list. It's if the item you're thinking of using as a business tax deduction isn't on this list, that doesn't mean it's not a legitimate business expense. You should check with your accountant or with the CRA if you're in doubt about the tax deduction potential of a particular business expense. One of the most exciting aspects of running a business in Canada is that no two businesses are exactly alike, even in the same industry, city, or region. Even similar businesses owned by the same people can be completely different. Property income. This is generally described as passive income since it's derived solely from the holding of a property. It includes interests, dividends, and rental income. It also may include income you have earned from holding shares in a privately held corporation. Investment income is usually reported on a T3, a T5, or T5013 slip that comes annually from your investment advisor, your accountant, your bank, that kind of thing. Income from property does not include any capital gain or capital loss from the disposition of the property. The rental income, if you have some, is reported on an individual's T1 return if the property is in the individual's name. If it's in a company name, the income is reported on the T2 return, but if it's a residential property, it's taxed at a higher rate than the general business income in that company because it's not considered active income. We'll talk more about active versus passive income later in the presentation. Common questions I get are whether or not a rental property should be held in a corporation or individually. The answer more often than not is that because it's taxed similarly in either case, there really isn't a tax advantage to do so. However, there may be other things to consider. Again, you should get advice on your particular situation before making any decisions. Other income. This is kind of the catch-all for things that don't fall into property, business, or employment income. Retirement benefits, death benefits, family assistance, educational and training payments, annuity payments from deferred profit sharing plans, annuity payments from retirement savings plans, payments from employment insurance, and other compensation payments such as WorkSafe or social assistance. Most of the WorkSafe and social assistance payments are not considered taxable income, but they still have to be reported on the individual's tax return. Capital gains. The capital gains deduction on small business corporation shares, farm property, and fishing property was introduced to encourage entrepreneurship, risk-taking, and to support equity investments in large and small businesses, including farm and fishing businesses by Canadians. The capital gains lifetime exemption is, as of 2015, it was $813,600, and that's inflated each year, so that will grow for 2016. Only 1/2 of a realized gain on the disposal of an investment or property is taxed, and taxed at a different rate than other sources of income. There are no capital gains on certain transactions. They're listed here. The capital property is gifted to a charity or other qualified donee. Certain exchangeable shares, disposition of your principal residence of your home, and upon death, if your property is transferred to a surviving spouse, there are no capital gains on those transactions. The 2015 federal budget increased the lifetime capital gains exemption for qualified farm or fishing property on or after April 21st, 2015 to the greater of $1 million and the indexed lifetime capital gains exemption. It's a fairly complex area of tax, so if you are preparing to sell the shares of your company, if you're preparing to sell land or your farm or your fishing property, you should seek both legal and accounting advice when doing so because there are some fairly complex tax issues around that. The next slide is a bunch of numbers. It's New Brunswick personal income tax brackets and rates, the combined marginal rates for federal and provincial taxes. The numbers that are highlighted in red are the majority of the changes that happened with the federal and provincial budgets last year. So what does this all mean? I have some examples. If you earned $100,000 both in 2015 and expect to earn in 2016, because of the changes in the budgets, you would save about $235 in tax between the 2 years. If you earned $200,000 both in 2015 and 2016, you would pay about $2,200 more in tax in 2016. If you earned $300,000 both in 2015 and 2016, you would pay about $6,800 more in tax. So having said all that, we have heard rumors and whispers that because the federal government raised the highest tax bracket, the provincial government may lower their rates, but we won't know for sure if that will happen. On Monday when the budget's dropped, we will know for sure. Currently, we are the highest tax bracket in Canada for those top earners. Individuals have child and family benefits tax-wise. There's the Canada Child Tax Benefit, the CCTB, which is also has components of a National Child Benefit Supplement and a Child Disability Benefit if your child is disabled. That benefit is income tested, so lower income families generally tend to receive more. If you have higher income, you don't get any of the CCTB. The Universal Child Care Benefit is the flat rate. It's $60 or $160 per month, depending on the age of your child. The Child Tax Credit was the ability to claim an amount for child on your tax return. That was eliminated in 2015 when they enhanced the Universal Child Care Benefit. The New Brunswick Child Tax Benefit is another one that's income tested, and that's for lower income families receive that benefit. And there is a proposed new National Child Care Benefit that's going to replace all of the federal programs. It's going to be income tested, and it's going to replace the UCCB and the Canada Child Tax Benefit. There's also other family and individual benefits, the GST or HST credit that people receive quarterly for lower income. There's a working income tax benefit program for lower income. They get a refundable tax credit at the end of the year. And there's a New Brunswick working income supplement that's very similar to the working income tax benefit. Individuals have several deductions available on their taxable income, so it lowers the amount of income that you have available to be taxed. Your RSP, RPP contributions, if you are receiving a pension and wish to split it with your spouse, you get a split pension deduction. Any union or professional dues that you pay, childcare expenses, moving expenses, carrying charges and interest, employment expenses, and there are others, but these are the most common ones. There's also tax credits in the Canadian taxation system. So you're credited at 15% of the total amount that you pay. Basic personal amount and age amount that everybody gets. It's about almost $12,000 for 2016. If you have a spouse or eligible dependents that aren't working, you can claim their basic personal amount. Family caregiver and infirm caregiver amounts are amounts that are credited to those that are giving care to family members. The amount that you pay into CPP and EI, you're credited at 15% of that as a tax credit. Volunteer firefighters and search and rescue volunteers also get preferential tax credit. There's an amount for working, the Canada Employment Amount, that self-employed people don't receive. Public transit passes. So if you buy annual transit passes or monthly transit passes, you can claim those on your tax return. Children's arts and fitness amounts. As of 2016, the arts amount is a tax credit and the fitness amount is a refundable tax credit, which means that if you pay $1,000 in child fitness expenses, you will get $150 back from the government. There's a home buyer's amount for people that purchase a new home, adoption expenses, disability amounts, interest on student loans, and the tuition and education amounts that you receive for being in school, as well as a common one are medical expenses. There are several programs that the government offers to individuals that are taxed at a different capacity than regular savings plans. So if you have a registered pension plan, then that gets deducted from income, so that's the tax preferential part of that. If you have a registered retirement savings plan, there's two pieces to this. Your contributions lower your taxable income, and any income that is earned throughout the year is sheltered from tax while it's in that RRSP. Registered education savings plans, these were set up by the government similar to RRSPs. They don't reduce your taxable income, but any contributions that you make to that plan, the interest and dividends that they receive within that plan are sheltered from tax. As well, the government has a program that will contribute to a registered education savings plan. The same with the registered disability savings plan. You set this up for a disabled person and you make contributions to it, and the government will match contributions based on the income of the beneficiary of that plan. There's also pooled registration pension plans. Those aren't as popular, especially here in New Brunswick, but they do have preferential tax treatment as well. Tax-free savings accounts are amounts that you can put into a savings account. It's indexed each year. In 2016, it's a maximum contribution of $5,500. Last year, it was $10,000. And basically what these are, they're vehicles that you can save money in, and any income that's earned on your investments within your tax-free savings account is sheltered from tax. You don't have to pay any tax on the interest and dividends earned in that plan. So we'll move on to corporations. The corporation is the most popular form of a business structure in Canada, which isn't surprising when you consider the increased liability protection a corporation provides over a sole proprietorship. There are several different types of corporations in Canada. The Canadian Controlled Private Corporation is the most popular, or CCPC. There are public corporations, which generally have a class of shares that are listed on a designated stock exchange, or you can elect to be treated as a public corporation. Corporations controlled by public corporations and other private corporations that are not controlled by one or more public corporations, are not controlled by one or more prescribed federal crown corporations, and aren't controlled by a combination described in these two previous conditions. And then there are other corporations such as non-resident. Canadian corporations are taxed differently than other forms of business. The most obvious tax change is that a corporation is a legal entity within itself, and it's taxed separately from the individuals that own the business. As a business owner, you would file both your T1, your personal tax return, as well as a T2 corporate tax form. But tax-wise, there are also different types of corporations, and the type determines whether or not the corporation is entitled to certain rates and deductions. In Canada, preferential tax treatment is given to the CCPCs. The tax advantages of a CCPC are listed here. The definition of a CCPC is that it has to be privately owned and has to meet all of the following conditions. It's a corporation that's resident in Canada and was either incorporated in Canada or outside of Canada but became resident within the year. It's not controlled directly or indirectly by non-resident persons. It's not controlled directly or indirectly by a public corporation. There's a few other ones, but no class of its shares is listed on a designated stock exchange. Basically, there's a definition that says it has to be Canadian controlled and private. When you choose to structure your small business as a corporation in Canada, it's definitely worth making sure you can set it up as a CCPC because of the corporate tax advantages. Basically, the Canadian-controlled private corporations are the Cinderellas at the ball, while other corporations are the ugly stepsisters. The biggest advantage is being eligible for the small business deduction, which applies to the first $500,000 of active business income. The net federal rate is 11%, and in New Brunswick, the small business rate in New Brunswick decreased January of last year from 4.5% to 4%. So the combined rate that a business pays under $500,000 of net profits is only 15%. There is a higher rate of New Brunswick income tax. It's 12%. And the combined non-small business deduction rate is 27%. So if you can fall into that small business deduction, your difference in your tax rates are 27 versus 15%. So people are often asking me, how can I reduce my corporate income tax? There's several ways you can do it. You can do it by earning investment tax credits, and there's several that are offered to Canadian corporations, specifically in New Brunswick. The apprenticeship job creation tax credit is that a corporation can earn an ITC equal to 10% of the eligible salaries and wages paid to eligible apprentices in the tax year. The cost of qualified property. So this is new prescribed buildings, machinery, or equipment acquired during the year to be used in certain activities, manufacturing or processing goods for sale or lease, logging, farming or fishing, and Canadian field processing. There were ITCs available for prospecting, exploring, extracting, and developing minerals, and exploring, drilling, and operating an oil or gas well, but these have been phased out as of 2015. There are research and development investment tax credits and refunds, or SHRED, as they're often called. To qualify, the work a company performs must advance the understanding of scientific relations or technologies, address scientific or technological uncertainty, and incorporate a systematic investigation by qualified personnel. That's the definition by CRA. Sometimes the type of work that qualifies includes experimental development, applied research, basic research, and support work. If you have SHRED, you should be engaging scientific experts and chartered professional accountants to help you deal with your claims. These are complex issues and detailed transactions that CRA almost always scrutinizes very carefully. There's an investment tax credit available to corporations, so an employer that's carrying on business in Canada, other than a child care service business, can claim a non-refundable tax credit to create one or more new child care spaces in a new or existing licensed child care facility for the children of their employees. The non-refundable tax credit is equal to the lesser of $10,000 of taxes paid and 25% of the eligible expenditure per child care space created. There's also some New Brunswick Incentives. You can claim a tax credit on contributions made to a registered political party. There is the New Brunswick Small Business Investor Tax Credit. So effective for the 2014 tax year, there's a new 15% non-refundable tax credit is available to corporations that receive a New Brunswick Small Business Investor Tax Credit. The maximum credit is $75,000 based on an investment of $500,000. There's also a New Brunswick Refundable Research and Development Tax Credit that's tied with SHRED, and that's available to companies that are resident in New Brunswick. The other way you can reduce your corporate income tax is by utilizing business deductions. These are all very similar to if you had a sole proprietor business. And again, this list is not exhaustive. There are many expenses that can be used in your business. The 2015 corporate income tax rates are here by province, and I've sorted them from top to bottom. So the highest tax rate essentially is at the top. So if you notice that New Brunswick falls right into the lower to middle bottom for corporate tax rates, which is a good thing for us to attract business. Personal service corporations. What is a personal service corporation? Bluntly, a designation by CRA that you don't want, because a personal service corporation, aka a personal service business, is not allowed to claim any of the standard business expenses, including the small business deduction. Technically, a personal services corporation is a business that carries on to provide a service to another entity, such as a person or partnership, that an officer or employee of that entity would usually perform. So this is a lot of consultants, especially in the IT stream, that they are incorporating and then offering their services to a company. And CRA is looking through that corporation and saying, no, you're really an employee. So how to get around this is have more than 5 full-time employees of your company, which obviously isn't reasonable for a one shareholder carrying on business, or provide services to an associated corporation. So to get around that, you could work for multiple clients. Make sure you renew your contracts frequently. Avoid the perception of a long-term relationship. Invoice your client regularly for work performed. Don't get paid and invoice later, or don't get paid on a regular income stream. And avoid the perception that you are an employee. Set your own hours, use your own equipment, have your own business cards, etc. If you are a contractor who provides your services primarily to one company, don't panic, but do familiarize yourself with the issue, particularly CRA's distinction between employees and independent contractors, and take what steps you can to enlarge your small company's horizons and protect your corporate status. There are HST considerations in operating a business, either individually or corporately. I quite often get asked who should register. Most goods and services are considered taxable and are subject to HST. So when your total worldwide supplies from all your businesses exceed $30,000 in the current calendar quarter, then you must register for HST and start collecting in the next month after that quarter. Some goods and services are taxable at the rate of 0%, but they still need to be reported. These are some common examples. And there are a limited amount of goods and services that are exempt from HST. If you have any questions about HST, you should definitely talk to your accountant and make sure that you're on the straight and narrow. CRA likes to do HST audits on a regular basis. There are payroll considerations when you have a business. Employers have very specific responsibilities. You must keep detailed and accurate records of what you're paying people. You have to calculate and withhold the Canada Pension Plan contributions, employment insurance premiums, and income tax deductions based on the amounts you pay your employees during each pay cycle. You have to calculate the employer portion of these premiums and remit all of that, everything that you've deducted along with the employer's share, to CRA on time for your payroll cycle. That could be annually, quarterly, monthly, semi-monthly. You have to complete and file annual information returns, otherwise known as T4s or T4As. For employers with 3 or more employees, including the owner, you're required to register with WorkSafe NB within 15 days of the start of the business or within 15 days of the start of the third worker's employment. Contractors and subcontractors who are not individually registered with WorkSafe NB are also considered to be your workers for the purposes of workers' compensation, since the contractors are regarded as being regular workers. We get a lot of clients come in and they get hit with WorkSafe audits because they've hired somebody to hang drywall in their office and they didn't check their WorkSafe status, and come to find out that contractor doesn't have WorkSafe, and that became the employer's third worker, and they end up owing workers' compensation premiums on that work. So to wrap up, common questions that I get asked: what do I need to file my taxes? You need details of personal income, T4s, T5s, T3s, investment statements, etc. Details of your business and or rental income and expenses for the year, last year's notice of assessment, and amounts paid by installments to CRA throughout the year. People also ask me how they can save money on their accounting fees. So the number one thing is to stay organized with your checks, invoices, receipts. Keep separate records for business and personal activity. Summarize and tally records wherever possible. And if you have multiple businesses, keep separate records for each business. And also stay in touch with your accountant throughout the year, especially if something is changing in your personal or business life. It's always easy to get advice before the event happens rather than after. So that's it for my presentation. If you have any questions, you can use the chat window or the Q&A section off to the right to ask any questions, and I will read them out and try to answer a few. So one question I had is student loan tax reductions. Does it have to be loans in the country, or can it be loans in other countries? I'm not 100% sure, but I do believe that the student loan interest that's paid has to be through the National Student Loan Service Center. It's an interest statement that you get, and that is allowed to be on your tax return. Loans received from other countries, I would have to look into specifically on whether or not that interest is tax deductible. So the payments are not tax deductible on your student loan. Those are considered principal payments, but any interest that you pay is. For other countries, I would have to look into that and look it up and get back to you. I had another question around student loans, whether or not it's a government loan or a bank loan be considered. Again, I believe it's just government loans that are allowed for the student loan deduction, the interest deduction. Thank you very much. I will hand you back over to Krista, and thank you again.
Thanks, everybody, for tuning into our very first webinar, Lunch and Learn. I hope everybody learned a lot about their personal and corporate taxes, and Jill certainly had some great expertise to share, so thank you, Jill. And just to let you know that as a thank you, we are making a donation in your name to the Chamber's Scholarship Fund. So we'd also like to say a big thank you to University of Fredericton. They're sponsoring our Lunch and Learn webinar series. And our next one is Wednesday, February 24th. The presenter is Genevieve Coates. She's the owner and principal consultant at Generate Creative Consulting, and she's going to be teaching us about email marketing. So thanks everybody for tuning in, and have a great day.